name is Alex Chosovsky, and I'm the Director of Speaking Services here at ITR Economics. I wanted to talk to you a little bit about the electrical equipment industry today, and really to address some of the most commonly heard questions that I encounter while I'm on the road making presentations to companies that are involved in the manufacturing or distribution of electrical equipment. So the first question that I most typically get is, what's going on in the electrical products industry right now? What is the current state of affairs? And there are a couple of different ways to answer this. There are multiple data series that we leverage to assess the current positioning or performance in the electrical sector. The first thing that I typically point to is U.S. electrical equipment production. We are stripping out appliances from that series, and what we see there, this is an index, so understand that an index essentially tries to capture a particular value in a certain period of time and then use historical data and future data, meaning forecast values, as a reference point relative to that baseline number. So for electrical equipment production without appliances, the 2012 value was the baseline, and relative to that number, the sector is up about 2.3% year over year. So as you can see, in a fairly long period of time, more than 6 years, there has not been a whole lot of growth on a rate of on an absolute basis when you look at electrical equipment production. It's essentially been a relatively stable, relatively flat market from both a absolute value or a moving average basis and a rate of change basis. But I can tell you that the good news is that the last 2.5 to 3 years have represented a period where the growth rates were improving over time. So coming off of a mid-2016 low, the annual growth rate for U.S. electrical equipment production without appliances is currently at 2.7% year over year, so that's a positive number. And more meaningful to me in terms of interpreting what is likely to happen in the near term is looking at that 3/12 rate of change, or the quarter over quarter growth rate. That is currently at 3.1%, and although it has come down slightly over the last several months, it still remains above the 12/12, which means that at least from a production volume, from what's going on in the industry right now in terms of manufacturing, that indicates that over the next 1 to 2 quarters we'll see further movement to the upside on that annualized number, which is a fairly favorable signal as to what to expect in that near term. There are other ways, as I mentioned, to look at it, and some of those things are pointing to perhaps a bit of a slowdown, and that's another question that I get very frequently, is what are some of the signs? You talk about the slowdown in the overall macroeconomy. Are you seeing any signs of slowdown in the electrical products industry specifically? To which I answer absolutely yes. There are signs of a slowdown emerging for electrical equipment as well. One good series that I can use to attest to that point is U.S. electrical equipment shipments. So this is product that has already been built and is now being shipped to clients. Although it too is up 3.6% on a year-over-year basis, and the 3/12 still remains above the 12/12 at 4.7%. One of the things that we've seen is that near-term growth rate, the quarter-over-quarter rate of change, has come down quite sharply over the last couple of months. So the last time we saw a peak in that growth rate was back in September of 2018, and that was at 10.2%. That's the quarter-over-quarter growth rate. As I mentioned, it's less than half of that now at 4.7%. So although technically that is not a near-term indication that the annualized rate of change is going to turn over in the immediate future, it does show that the momentum in the industry is subsiding somewhat, because the last 3 months of data, the growth rate has not been as robust as it was in the fourth quarter of 2018. Finally, I also want to point to electrical equipment new orders. That's the series that basically leads production and leads shipments. And there, again, although the rate of change is positive year over year at 3%, the shorter term indication, the 3/12, that's actually downward past the 12/12 and is currently sitting at 1.6%. So similar to what we saw in shipments, the peak in new orders activity happened basically in the latter part of 2018, it peaked around 10.8%, and you can see that in a relatively short period of time, with that having dropped to 1.6%, it really shows how the momentum is slowing in that particular industry. The fact that it has now downward passed the 1212 is an ITR checking point. It's basically our way of telling that if this trend continues for 3 consecutive months, where the 312 is below the 1212, that will represent a trend reversal on the annualized number and a cyclical peak forming in that new orders activity. So although it's not possible to confirm that just yet, clearly the signs are there that the slowdown may be emerging in terms of electrical equipment, and that will translate to slower levels of performance on new orders, likely in the second and third quarter of this year, if the trend in the 312 holds up. Other ways that we see that the slowdown is manifesting itself: unfilled orders for electrical equipment are currently down 1.8%, and the 312 was at minus 2.1%, so further negativity in store for that series. In fact, the unfilled orders have been declining consistently since late 2016, and that essentially, the way that I interpret that, is that the inventory, or the backlog, I should say, rather than inventory, backlog of orders that exists in the electrical sector is being eaten up, and so the backlog is shrinking, and that shows again some signs of a slowdown emerging in the sector. Another way to tell that is that inventories themselves, what I alluded to in the previous statement, are rising. So currently, electrical equipment inventories are up 7.3% year over year, and on a quarter over quarter basis, they're actually up 9.6%. So that means that the rising trend in inventories is actually going to continue. They're currently sitting at $5.2 billion, according to the U.S. Census Bureau, and so the inventory levels are clearly starting to swell. Typically, that corresponds to lower levels of new orders and lower levels of production later on down the road, especially from a distribution perspective. When inventories are quite heavy, distributors tend to order less products towards the latter part of the year, and that's certainly looking like it's going to be a possibility towards the latter part of 2019. And I guess the final thing that I would like to point to in terms of showing that the momentum in the electrical equipment sector is starting to slow somewhat is the decline in the capacity utilization rate. So capacity utilization is basically a metric that shows what percentage of the existing infrastructure, factory space, and production capacity is being used to meet current levels of demand. That's actually down on a year-over-year and a month-over-month basis. We typically gauge the month-over-month performance because capacity utilization tends to be quite volatile in nature. So currently, relative to the same month last year, the latest data point is down 2.4%, and the actual reading, the raw data point, is at 74.4%, and that's really the lowest level that we've seen since the post-recession turnaround back in 2011-2012. So a lower level of capacity being utilized to meet current levels of demand certainly, in my mind, reflects a slowing condition in the markets overall. Some interesting dynamics going on in trade of electrical equipment that I also get asked questions about. So exports of electrical equipment from the U.S. to the rest of the world currently up 4.4% annually, but on a quarter-over-quarter basis, they're flat. That shows a slowdown in momentum for exports. There are multiple reasons why this could be happening. Perhaps it's related to trade and tariffs, with some foreign entities buying fewer American products in response to some of the things we're doing with trade. I don't think that's the only thing to consider here. You've got to think about the strength of the US dollar. You also have to clearly consider the weakness emerging in the rest of the world. I talked about it on a different recording, but we discussed the slowdown in Europe that's really manifesting itself in many different ways, the deceleration in China, and certainly even the slowdown in Canada and Mexico relative to what is going on in the United States. And so those countries are just starting to buy less less American exports of electrical equipment. At the same time, imports of electrical equipment into the US are up quite sharply. They're up 8.4%, and the 312 is at 12.4%. So that means that they're going to rise even further on a 12-12 basis over the next 3 to 6 months. Again, many different causes behind this, but I imagine that the strength of the dollar is a function that's allowing the export or the imported product to be cheaper, relatively speaking, than American manufactured electrical equipment, and that's kind of tilting the favor in the direction of foreign products versus domestic products. I think the costs of materials here in the US also should be considered in light of all of that. For instance, when we think about tariffs and commodities and how those two effects play off of each other, well, steel, which is under a 25% tariff, that's up 15.4% year over year, but copper is actually down just over 14%. Copper is very pervasively used in a lot of different sectors and really is a benchmark for what commodity markets are doing. So when you think about electrical equipment industry and the diversion that we see in those two different commodity prices, you've got to continue to focus on profitability. And that's the last thing that I want to address in terms of the factors that electrical equipment suppliers should be paying attention to in 2019. It's hard market to navigate when you've got steel up double digits but copper down double digits. And make sure you adapt a very aggressive kind of proactive approach to managing your purchasing, and then to reflect in your pricing environment the prices that you're paying for the materials right now. Because I still find it fascinating that some companies are operating kind of in a, we've always done 1 or 2 price increases per year, so we're going to continue to do that. Current market conditions mean that you've got to be more proactive, you've got to be more ready to pull the trigger to raise prices when it warrants it, and at the same time be aware of your customers' rising price sensitivity as the world of electrical equipment slows around you. So it might not be as easy to pass price increases along to your customers 12 months from now relative to what you can achieve today, because everyone's still feeling pretty good about themselves. So with all of these forces in mind, with the slowdown that's starting to kind of emerge in the electrical product sector, and the dynamics in trade and the dynamics in the commodity input prices, make sure you stay vigilant, make sure you pay attention to what's going on, and the most important thing is make sure you have an unbiased, independent source of information that can tell you the latest developments and help you interpret what that means to your business. I believe that ITR Economics can be that for you, and I'm always available here to answer any questions that you might have. So thanks so much for spending a few minutes with me today. Talk to you soon. Take care.